Lisa Bennett here, workforcemillionaire.com. Today, we are going to compare 3 different auto manufacturers worldwide. We're going to compare their financials so that you could make a decision about whether or not you think that one of these companies would be a good investment for you. So I'm going to go back to some of the original slides that we shared out yesterday. Let me share my screen here. This is the Rate That Stock Challenge in the Let's Do the Numbers series. We are doing individual stock analysis, not a market analysis, not index or fund investing, not buying whatever is popular, not buying what everyone is using like Zoom, not coattailing off someone else's investments. We are individually analyzing stocks so that we can understand individual companies. Where's the information available? I created a simple slide today to show you 3 different places where you can find the information on these companies. It's all available on the company's website. Every company will give you a link somewhere to get their investor reports. It's also on the SEC website because all of their investor reports have to be submitted to the SEC within, I think it's 90 days of the end of their quarter. The 10K is the audited financials for an American company. It contains balance sheets, income statements, cash flow, and statements of shareholder equity. And just as a note, cryptocurrency is not a market regulated by the SEC, so their reports are not available on the SEC. So here are the 3 ways to find the company reports for any given publicly traded company, their website on their homepage, the Edgar database on sec.gov, which frankly is one of the best government databases I have ever seen. A lot of really good usability engineering went into that website. And then Google is your friend. So when I was finding some numbers today to be really difficult to calculate, I asked Google. Google has information to share, just like this little guy is sharing his ice cream cone. So here is Edgar. See at the top, it's sec.gov. It gives you this really nice search bar. I just type in Toyota, and the first thing that comes up is Toyota Motors. The ticker symbol for Toyota Motors is TM. Or go look on the company's website. This is Honda Motors. And at the top of their website, it says investors. That means you. That is where you would click to find their reports. And it also happens to be at the bottom of their website under investor relations. Or Google is your friend. Here I did a search for 2020 10K for Tesla, and it came up with the reports. It came up the report on Edgar, and it came up with the report on the Tesla website. The database in Edgar is very friendly. This again is the example I gave yesterday when we were looking at Apple. It shows all of their filings that are recent, since July, it looks like. Their current reports, their annual reports, their quarterly reports, their annual meeting proxy statement, and ownership disclosures. There is a lot reported to the SEC. You don't need to look at all of it. But for instance, they may have filed something special that talks about the impact of COVID-19 to their business. They will file a special report if any of their officers resigns from the company. That's a requirement in the SEC. So there could be many, many reports involving financials and different aspects of running the company that are filed because it is a publicly traded company. So we are looking for growth over time. In the black, if the company is up and to the right, they're making more money over time. They're not stagnant and they're not losing market share. I looked up a number of these reports. The Item 6 in Apple's report was called Selected Financial Data. It started on page 20. On the Toyota report, it was at the bottom, page 145. And the Honda report was so confusing for me, I went out onto Google and searched for the numbers I was looking for. So I have to say, this isn't easy to get all these numbers, but Google is your friend. So if you don't want to spend all the time I just spent this morning finding the numbers behind some of these slides, and you really want to compare how well two companies are doing against each other, I would say go to Google. And also on the reports, the numbers, they will tell you at the top of each report if the numbers are represented in millions or thousands, or if it's a straight number. Here is a 5-year trend for an automaker. 2016, 17, 18, 19, 20. What has been happening? Their revenues have been going up steadily. Gross profit has been going up steadily. Income or loss from operations, it looks like 2020, they made the first profit. This company was not profitable in 2016, 17, 18, or 19. So their earnings per share are actually listed down here. 74 cents a share for last year, as opposed to negative, which means the shareholders weren't making, well, the company was still in the red. It wasn't making a profit up until 2020. Which company would this be? Do you know? Also, remember our PE ratios that we were looking for yesterday? The PE ratio of this company, because the stock was $700 a share at the end of 2020, and it shows here that the earnings per share were 74 cents. The PE ratio of this company at the end of 2020 was 946. So what does that mean? It's a very, very, very high number. That means the stock is, according to all the numbers that we look at, it is overvalued right now. People are paying way more money for this stock than the actual numbers would indicate the company is worth right now. And number two, it means people are speculating. People believe this company is going to make much more revenue over time, have a large market share, they're doing well, they believe in the strategy, they believe in the management team. People are speculating on this stock. Here's another 5-year trend report. And as you can see, the dollars here are represented in yen. So this is a Japanese company. And the numbers over time start here, 14, 15, 15, 14, 13. The numbers for sales revenues for this company are decreasing. It took its first real hit in 2020. Why is that? We all know what happened in 2019, and it looks like that impacted it heavily in 2020. You could read their investors report and see a lot of detail around how they were impacted by COVID-19. Dividends declared per common share have gone from 90 to 97 to 110 to 112 to 84. So the dividends in the last year have dropped. A different company, a 3-year trend. What has happened with them? They went from 27.4 to 28.1 to 27.7. So they got hit this year compared to last year. Let's see. Other income has gone up. That's about the cost of products sold has gone 23.3. It went down a little in 2020. Now let's look at the numbers that we did yesterday, the PE ratio. So this is comparing the price of the stock to how much the company is earning for you because you invested in them. So again, the example yesterday was if the stock's trading at $20 a share, their earnings are $2 a share, then their PE ratio is 10. So theoretically, if everything stayed the same, if this company wasn't growing, it was really stable, you would get your money back in 10 years. The reason stocks tend to have high PE ratios is investors tried to predict which stocks will enjoy progressively larger earnings. So let's look at our 3 auto companies' PE ratios. A negative number means the company isn't profitable yet or wasn't profitable that year. So auto company 1 in 2019 had a negative 90.3 PE ratio. What does that mean? Oh my goodness. It means they're not profitable and people are paying a high amount for their stock. December 2020, their PE ratio was 12.25. What does that mean? That means now they're positive. It's a positive number. So now they are profitable and people are paying a tremendous amount for their stock. Auto company 2 went in 2019. Remember when we got hit by COVID-19 from a 10.9 to December 2020, they had 12.05 as their PE ratio. These are reasonable numbers. Usually the numbers are going to be between 10 and 20. And then 2019 for auto company 3, 2019, their PE ratio was 15.92, which is slightly higher than 2020, which means that their stock is a little bit discounted in December 2020. But there's a bunch of stuff we still don't know about these companies. Quick ratio. The quick ratio is showing you how well the company could pay off its debts in a pinch. If they can't pay off their debts, then they are running a company that's not very clean, in my opinion. Remember my example I gave yesterday was all of the housing, all of the real estate I have invested in. The question is, could I pay them off if I had to? Yes, I could. So that gives me a quick ratio of at least 1. If I could pay off all those houses, there goes my debt. So you want a number higher than 1. So to me, it's about solvency. How solvent are you? You have debt, you have assets. What could you do to pay off your debt? You want a number higher than 1. Company A in 2019 was at 0.73. They could not have paid off all their debt if push came to shove, but in 2020 they could. Company B, they have a quick ratio of just over 1, and in 2020 it's just a little bit higher, so that's a good solid number. So someone is managing this. There are people who are in charge of the finances in the company who are very meticulous about letting management know, hey, this is what our numbers look like, because they know that the investors care. They are managing this definitely down to the decimal point. And then company C has been a steady 0.93 for the last 2 years, which kind of surprises me. But that means that they could almost, but not quite, pay off all of their debt if they had to in a pinch. Evaluating the management team, we're not doing today, but you can go out onto the 10K report and look at their descriptions of you can also go on their website and look at the descriptions of the C team, right? The CTO, CFO, COO, CEO. Look at their histories. And in the investors report, the 10K, you can look at how much stock they have in the company and how many stock options they have in the company. Again, the strategy would be in the annual report. Do they have a defensible moat? So we are looking at 3 car companies, one of which was unprofitable in 2019 and finally made a profit in 2020. And looks like they are on an upward trajectory and people are paying a tremendous amount for their stock because they're speculating. A company that looks pretty stable, and actually the other 2 companies have been hit at least a little bit by COVID-19. Return on equity is considered a gauge of your profitability and how efficient you are at generating profits. So really, it's how well are you using your assets? all three of these companies are going to have factories where they fully utilized during 2019 and 2020, like was production at full production rates. Everything they created was it sold. How efficient is your company running? And it looks like the long-term average for the S&P is 14%, and you're looking for something over 10. So, so here we are, Auto Company A, how they're using their assets. So in 2019, they were at negative 15%. So they were not at full production. That's how I interpret this. And in 2020, they were at 4.8%. So still, based on how many assets they have, they're not fully utilizing their assets right now. Auto Company B. This number must be wrong. I must have something wrong here. That number looks outrageous. Let's see if I have it written down everywhere. Company B, the return on equity. Oh, yeah, I left out a decimal. It's 7.5%. So they're 7.5 in 2019, 2020 was 5.6. What does that mean? They probably have some underutilization in their factories, my guess. 2019, Company C, 9.8% in 2019, 10.2% in 2020. So they're utilizing their factories better. Like right now, of comparing these three companies, Auto Company C would be having the best ROE. Profitability. So your operating margin, you're taking your income divided by your revenues, and you get your operating margin, and it's usually a percentage. How profitable is my company? And these numbers can vary by industry. And then dividends. So I did run a dividend chart for these three companies. It shows how much of a payday you're going to get as a shareholder from the company every quarter, and they're not required to pay you dividends. So here are the dividends. Auto Company A has never paid, as far as I can tell, a dividend to the shareholders. Remember what's happening with Company A. They're going from being in the red to being in the black. So either they're a startup or they've had issues with productivity up until now, and they have probably never declared a dividend for their shareholders. They could have numerous reasons for that. Auto Company B in 2019 had 78 cents a share, 2020 had 81 cents a share, 2021 58 cents a share. So they are reeling a bit financially from COVID-19 or whatever is going on in their company, and they're paying out less in dividends. Auto Company C in 2019 went from $3.12 a share. So this is the highest paying dividend company of all three. 2020, $3.24 a share. So if I had 10 shares of this company in 2021, they would have sent me a check for $35.90, roughly 4 times that year. So what's that? $150, $154. So that's a pretty decent dividend compared to the companies that I hold stock in. So if you are looking for dividends from a company right now, you would look to Company C, right? Auto Company C. The PEG ratio. So remember, price to earnings ratio isn't enough in and of itself, because it's saying, well, the price of my stock today is this, and my earnings as of today is this, but I'm not comparing that at all to last year. And people would like to know, well, am I growing? So what if I say I made $1 million last year, and the share price is good? People are going, oh, woohoo! But what if the year before I had made $5 million and you didn't know that, because you can't see my history when you're just looking at the PE ratio. So it is helpful to see what your trend is over time. You want to know the growth of the company. So let's look at those numbers. Here we go. Interesting. Auto Company A, again, 2019 was negative growth. 2020 was 8.1. That's actually quite high, especially in this industry. And 2021 was quarter one, so the end of March was 3.5. This industry, if I go out there and look at the industry traditional historical numbers, I believe are around 4 or 5%. So auto company A is getting closer, and that's just quarter one. They're getting closer to having a standard industry growth rate. Auto company B went from 0.2 negative, so they did not grow in 2019. They did not grow in 2020, and they are not growing, even less in 2021 quarter one. They are being hit, right? They are not, they are on the decline right now. And then auto company C went from minus 0.5 in 2019. We did have COVID. It had huge impacts on companies B and C that are not domestic. They are not from the United States. So they dealt with shipping and parts and the whole value chain that happens around the world. They're in Asia. It hit them very hard. So they went from negative 0.5 growth in 2019 to 0.2 in 2020 and negative 0.4 in quarter one 2021. I'm not even sure what the answer is on auto company C. I don't know if they're growing. I don't know if they're declining. I don't know if someone is taking their market share away from them. I don't know why their growth would look like this. So here's the question that comes out of today's analysis of these three auto companies. What are you looking for when you are buying a stock? Do you look for a company that is in a big growth phase? Well, which of the companies is in a big growth phase? That would be company A, right? A company that pays dividends? Definitely not company A. Company C was the one that was paying the highest dividends, over $3 a share. A company that's very stable over time, not losing market share, and delivers a very good, consistent product. Well, you would need to know what each of these companies is making and understand if it's a good product. You haven't evaluated their management team yet, but the stable over time one, as I recall, looked mostly like company C. And your answer to these questions will influence your decision on which companies to invest in. In other words, we can go through all this analysis. I can do numbers for you, and you decide which kind of company are you looking for. So just to do the unveiling here, company A is Tesla, company B is Honda, and company C is Toyota. It turns out by looking at the investment reports that Toyota has a large financial arm of their company and also do a lot of leasing. So it was very tangled for me to go through all their numbers. It was a whole lot easier for me to find a website that had done the numbers for me. So again, we're keeping it simple here. We will do another company tomorrow. This list is a good start of how to evaluate a company. Even knowing just the PE ratio and how to quickly evaluate a company's 10K puts you ahead of a huge, huge number of individual investors. Edgar is your friend. That's the SEC website. And I would like to show you, I also found another website. Let me stop sharing for a minute and bring that website up. I found another website that was really helpful when I was doing these. Here we go. Let me share that. This website is called finbox.com. I ran across it accidentally when I was doing Google searches here, and it would let me put a name in here of whatever company, and these are the data metrics it has already calculated for all these companies. You know, it's a consolidator. It's just gathering this information that's available publicly, running the numbers and displaying them, and also making charts, which I like charts. Charts make me happy. So I like looking at charts. So it already did the PE ratio. They've done free cash flow. They've done, what else are we looking at? Earnings per share. PEG ratio is one of the ones we looked at. So a number of numbers they've already done. So here, this was Tesla's PEG ratio. Remember, price, earnings, and growth. Oh my goodness, they have been all over the place. They worked really hard to bring this number up in December 2019. They got hit. And then December 31st last year, their growth started skyrocketing. I don't know what this looks like right now, but I suspect they are still growing. I know they're doing good production right now. As far as I know, there's no hangups in production at Tesla right now. Just by, I don't know if this is coincidence, but some of the top cars in the US have been Hondas and Toyotas forever. So I knew I was going to analyze Honda and Toyota. And then I wanted to show you what a difference Tesla makes when you compare these numbers. And I am working to compare only the car numbers, but Tesla, of course, also has the batteries and a number of other things Elon Musk is involved in. But to tease out the auto numbers and compare them side by side to other well-established automakers, it just so happens that I own one car from each one of these manufacturers sitting right out there in my driveway. I didn't even think about that until this presentation was almost done. But I do believe in all three of these companies. The one company that's represented here that I have had cars that were made by forever is Honda. I bought my first Honda in, I think, 1983. And I have had a Honda ever since. I have always loved their cars, and they make very good motors and engines. They last forever. No idea. I mean, as far as I can tell, the jury's out on Tesla because we don't have any really long-term Teslas yet. The Tesla hasn't been on the market that long. So that's the presentation for today. And I hope this was helpful to show you how to compare some of these numbers. If it seems really confusing, let me know. If you'd like to know less, let me know. If you'd like to know different numbers, I'll see if they're available on the investor reports. Lisa Bennett, Workforce Millionaire, helping you to rock your world of money.